Morning, everyone. Well, I won't talk about accounting issues because, well, BDO doesn't let me talk about accounting issues anymore because I only do tax. So when we look at can trade and when we're looking at moving into foreign jurisdictions, they're going to have employees now in South America and Brazil. We're going to have to establish some form of structure in that foreign country. We start looking at a whole host of potential tax issues that we can kind of fall into, which ultimately the company needs to deal with. And when Diane mentioned with Canada's tax rates, they are looking on the favorable side. And anytime you start getting favorable tax rates in one country, one of the things you can guarantee is going to happen is the other country is going to look at you or look at your country and say, are you really paying your fair share of tax in my country, or are you trying to ship the profits off somewhere else? So one of the things that really comes up is a transfer pricing issue. If you have multiple jurisdictions, if you're moving profits around, if you're selling in between divisions, transfer pricing is going to be an issue that's going to come up. One of the other things that we often see come up is just in regards to employees. When you have employees in foreign jurisdictions, if Can Trade is sending somebody down to Brazil, who is that employee working for? Are they working for the Canadian company? Are they working for the Brazil company? And so on. And the last thing, and something that Bonnie talked a little bit about, is just in regards to financing issues. And we have a whole host of rules when it comes to financing issues that we should be aware of. So to talk a little bit about those three, and if we start kind of with transfer pricing, just to give you an idea of what Canada thinks about transfer pricing and how important it is to the Canadian economy. Right now, Canada's got about 340 auditors who are dedicated to nothing but transfer pricing. They've got about 30 more in Ottawa at headquarters. And as well, they've got about 29 economists in Ottawa whose only mandate really is to work on transfer pricing. So it's a pretty big deal here in Canada. That number pales in comparison. One of the things, and this actually was said by one of my U.S. partners, the U.S. economy is broke, so they need every cent they can get. The U.S. plan on hiring an additional 1,500 auditors whose sole purpose is to look at transfer pricing issues. And to make sure that the U.S. are getting their share of tax. So it is something that is very much forefront. When you look at transfer pricing, Can Trade may just be starting up in this foreign jurisdiction. When it comes to transfer pricing issues, CRA, the IRS, the foreign jurisdictions, there really is no threshold. There is no company that's too small. Some of the things that are getting looked at and the hot topics, what triggers CRA coming in. If you're filing the T-106, just basically saying that, yes, I have transactions with a related party in a foreign jurisdiction. One of the questions on that is, do you have contemporaneous documentation to support their transfer pricing amount? If you ever take note of that box, you can pretty much just wait for the phone call because they are going to give you a shout. But from our experience, and definitely on Canada's side, there's kind of three main areas that CRA are really looking at when it comes to transfer pricing issues. And one of those is dealing with management fees for services between either subsidiaries back to the parent, just between branches, between the different countries. They're looking at financial transactions, so if there's debt going back and forth between the two companies, that's definitely an area, as well as the use of intangibles. So if Canada's developed something, a patent of those sorts, it's being used now down in Brazil, is Canada really getting its fair share of the profits from Brazil on that? When we look at management fees from a transfer pricing perspective and what CRA wants to see and what we would work with you to make sure that we have really kind of hinges on 7 main considerations, and that is, what are the services that are being provided? So if there is a management fee, just having a management fee to strip the profit out of a high tax country back to a lower tax country is not quite going to work. We need to actually be providing a service. What are the benefits of that service? And the benefit is really looked at from the recipient, so the person who's receiving, or the entity that's receiving the services, really what are the benefit that they're getting, and more importantly, what is the value of that benefit? What are the total costs? So from Canada's perspective, if Canada's the parent and CanTrade now is providing a service back, what is it costing Canada to provide that service, and are we actually covering off those costs? Will be quite important. Is it what type of allocation factor? Merely using a percentage of the sales is not really good enough. We need a much more thought out process when it comes to transfer pricing. Is there a markup applied? Are we just doing a flat amount? Is that flat amount realistic? We need to demonstrate whether or not the charges are duplicate. That is one thing that we have been seeing a lot more often, whether there's a double dip and we're getting a deduction in 2 different jurisdictions. And we also have to demonstrate whether or not the charges are of a custodial nature. So when we look at all those 7 things, we may have great documentation on 6 of them, but CRA is going to pick on the one that we don't have good documentation on and ultimately create problems for us, or at least challenges. When it comes to financial transactions, when we're looking at expansion into a foreign jurisdiction, obviously we need cash to do this. And Bonnie and Ralph both discussed a number of ways that we can get cash. Some of that cash may be able to be lent directly to the foreign jurisdiction, but oftentimes we see parent or CanTrade here, the one is having to go out and get the financing. Now they're lending down either to the subsidiary. So when we lend to that subsidiary, we need to start looking at what are the implications of having these related party loans. Are we charging arm's length interest? Are we charging what would be market rates? And when we start looking at market rates from, now we're dealing with 2 jurisdictions. The cost of borrowing in Brazil may be quite higher than what it is here in Canada, so perhaps the Brazilian company should be paying a higher rate. Because from Canada's perspective, they may look at a loan and say, okay, prime plus 3 looks pretty good here, but if the rate of lending in Brazil happens to be 15%, and that's where ultimately you're lending the funds, Canada for sure is going to take a run at you and say, well, you know what, this country would have lent at 15%, you're lending into it, you really should be charging 15% on the loan. Oh, and by the way, here's the tax bill for it because we're going to hit you with it. Part of the process when we're setting up these lending arrangements and structuring them really is getting involved in setting up a process, determining really what that arm's length rate should be. Develop a credit rating, look at the credit risk of the recipient, which is really important. So just as FCC is going to look at a credit risk from perspective of who they lend to, when we're lending to a related party, we do have to validate that credit risk of that foreign subsidiary. Try and find, or we have to find, comparable interest rates. It really does come down to what could that country lend at. And ultimately, again, documentation is key, because one of the things with transfer pricing, and Geoff's going to talk a little bit more to it in a moment, is really that documentation. It really comes down to it, because the reality is when CRA or the IRS or that foreign jurisdiction comes in and starts looking at you, it's 3, 5, 6 years after the fact. And I know for myself, I barely remember what I did yesterday, let alone what I did a couple of years ago. The last area that we've definitely seen a lot of action by CRA is in regards to intangibles. And intangibles really cover a whole host of things, from patents, models, designs, trademarks, trade names, customer lists, trade intangibles, marketing intangibles, all the intellectual type property where it's really much more difficult to put a value on it because it's often in-house developed, it's been developed over a number of years, but when we move into a foreign jurisdiction, now we have this foreign jurisdiction using what was developed now in Canada by CanTrade. That foreign jurisdiction is profiting on it, and if you have a situation, Canada's going to look at you and say, well, from a transfer pricing issue, you should be charging your foreign jurisdiction for the use of the properties or the intellectual capital that has been developed here in Canada. So it is something that needs to be looked at. We need to make sure that we are appropriately charging for that. You know, and it really does come down to a little bit of a numbers game, because obviously we're going to have the incentive of actually paying tax in the country that has the lowest tax rates. So, but we do need to keep all these things in mind. And obviously this is a very hot topic for CRA as well as a number of foreign jurisdictions, especially after what we've seen in the economy the last few years. So when it comes to transfer pricing, I mean, from what BDO would be helping CanTrade with, is, you know, helping in regarding setting up these transfer pricing studies, having that contemporaneous documentation on hand, working to have benchmarking services from North American and global databases, doing comparable company searches, transaction searches, royalty searches, brand and loan searches, just so that we have the documentation on hand for when either CRA or that foreign jurisdiction comes in. Second area that we've kind of looked at for CanTrade is just in regards to its employees going into foreign jurisdictions. Can create a whole host of issues. You have situations where CanTrade is going to send an employee down to Brazil. If that CanTrade employee has the ability to conclude contracts on behalf of CanTrade, and they're concluding those contracts in Brazil, what have we done from the concept of a permanent establishment? And permanent establishment is really what CRA and the foreign jurisdictions look at from perspective of, do I have an actual operation in this country that's subject to me to tax? So have I suddenly now triggered having a tax liability or at least a filing requirement in this foreign jurisdiction? You have a lot of clients that go to great lengths to not have to file in foreign jurisdictions. They hate filing in Canada, let alone filing in a foreign jurisdiction. So structuring things to make sure that we don't fall offside and that we don't create these permanent establishments if we don't want them, if we want to operate through a subsidiary relationship or something like that. We need to look at the treaties. You know, do we have a treaty with this country? When we start, you know, bringing profits back and such like that, or there withholding requirements. In regards to the employees, even from the perspective of, if I'm sending an employee down there and he can't conclude contracts, if he's working in a foreign jurisdiction, where is my employee subject to tax? Yeah, he may still be a Canadian resident and he has Canadian taxes to pay, but he may now have, or at least the company, CanTrade, may now have a withholding requirement in the foreign jurisdiction, which is really bad for the employee because he's having Canadian tax withheld. Now he's going to have Brazilian tax withheld as well. At the end of the day, he should only have to pay tax in one country, but there may be a cash flow strain on them. So we really want to make sure that our employees are, you know, properly structured, and even from the perspective of making sure they have the right visas and everything to get into these countries. Lastly, financing. I mean, Bonnie covered a lot of them, but one or two points on it is just in regards, from CanTrade's perspective, there are a number of thin cap rules here in Canada in regards to interest deductibility. If we are charging interest on a U.S. loan, or if we're not, if we've gone out and gotten financing here to finance a subsidiary, can we deduct the interest in Canada? We have a whole bunch of rules which basically say we can't if we're not doing it for the purposes of earning income. You know, just in regards to the interest that we are charging to the foreign jurisdiction, just being aware of withholding tax requirements in that foreign jurisdiction. Now we've got a foreign country paying interest out to Canada. We may have withholding tax issues. Can we get the withholding tax? Is the withholding tax that's ultimately paid, if it's paid by a Canadian company, do we get some sort of foreign tax credit for it? Just being aware of these issues and making sure that we ultimately can get them. When it comes to the tax issues that arise when we're looking at foreign jurisdictions, to quote Sergeant Phil Esterhaus, let's be careful out there. There really are a whole bunch of issues. And when things go bad, ultimately we have to get involved other professionals, and we'll hand it over to Geoff to talk about when things do go bad.